Well, there's a lot changing at the central banks at the moment, so I think it's an opportune time to sort of go over exactly what's going on with them, because obviously this always has quite an impact on most asset classes out there. We've seen stock traders wrestling with two clear opposing ideas, which is forcing the market in different directions, giving us a few gyrations. I mean, we've got, on the one hand, central bank fight against ongoing inflation, which is continuing to see quite aggressive rate hikes. But on the other hand, and something that it seems that the market's very focused on, is the danger that that does, or the risk that brings to ongoing growth. And growth has been hit pretty severely, but it has to be said that this is something that the central banks are quite happy with, because this is all part of tightening financial conditions, which we'll talk about a little later as we go forward. But as you can see from this, this is a Tech 100 daily chart, the NASDAQ as we call it. You can see the choppiness in the market, but we did have a pretty good July. This is seasonally supported as well to some degree. But the question is now, are we beginning to roll over, or are we going to continue higher as central banks seem to be sending pretty clear messages that the market should still be focusing on inflation, because they are. So a little bit more on that in a couple of slides later. But at the moment, this is the situation for stocks right now. We've got the Fed, the ECB, and the RBA already abandoning forward guidance. Now, the market has taken this move or shift to data dependence to be a sign of, well, maybe they might not be so aggressive hiking going forwards. That may have been a little overly hopeful, put it this way, overly optimistic. But it does mean that the next 8 weeks or so of data is going to be really important, and volatility seems to be likely to remain elevated on that. So are central banks worried about unknowns out there? Clearly. I mean, the fact that they don't want to give any forward guidance suggests to me they probably have no clue what's coming next. They want some flexibility within their policy structures going forwards. And, they don't want to get trapped into a corner and having to deliver something they don't want to deliver. So I think this actually makes a certain amount of sense. I think as interest rates are beginning to rise, the need for forward guidance is actually taken away, because there's so many fluid parts to all of this that I think they need that flexibility within their policy structures. But it does not mean necessarily that they are turning dovish or going to stop hiking. And we heard that very clearly from central bankers, particularly from the Fed, over the last day or so, including today. At the moment, the fear index, the VIX, this is obviously correlated, structured around the USA 500, the S&P. We've seen the VIX fall. You can see this chart on the bottom here, falling as the S&P rises. Again, sort of June and July very much a seasonally positive month. We've had a couple of issues supporting this market. One of them is the return of equity buybacks after the blackout period through earnings. That they're back now. This is helping support the market. But also look at this. Bank of America does this bull bear indicator. We were over extreme bearishness just a couple of weeks ago, and I think the market got overly short, and I think some of this move back in July was position squaring into month end, and the fact that maybe the market got a little bit too bearish, a little bit too negative in sentiment, and the squeeze happened. A lot of money was taken back off the table, and we had that move up. So, we saw a bit of a volatility warning as US House Speaker Pelosi landed in Taiwan, defying Chinese warnings. And it's going to be interesting. We saw the USA turn down on the back of that, but we have actually moved back up today on the back of some pretty solid US data. So, can the economy take the higher hikes or more hikes? Possibly. But, what does that mean for equity markets? Unclear at the moment. So we've got a bit of nervousness here, although we're seeing a very good rally in equities today as I speak. So, part of the month end, the seasonality helped. But looking forward, traders need to listen to what the Fed and other central banks are saying. This is really important now. Now, Powell has said the Fed is at neutral, around 2.5%. But don't forget, he's also suggested they are very happy to go past neutral if that is needed. So today we heard, I think Fed's Daily mentioning possibility of 3.75% or 4% at some point. Would that be an overshoot? We don't know. There's a danger they can overshoot, but what does that do realistically to stock markets. I think that could be a real heavy weight going forwards. We've seen financial conditions, which the Fed is trying to tighten. They've actually eased recently with the rally in stocks and the move back in bonds. So financial conditions easing is not what the Fed wants to see, and may keep them slightly more aggressive or hiking for longer and to a greater extent than markets are already pricing. So we've seen Treasury yields turn back up today as Fed speakers have come out quashing this policy pivot talk that was grabbing the markets. They suggested today no pivot in sight. And with financial conditions where they are, they're likely to keep on hiking. So I think this is a big issue for the Fed. And I think these Fed speakers have sent a very, very clear message on behalf of the Fed and Powell himself. But I think one thing that's a derivative of all this is that I think we can expect more volatility over the next few days, plus the fact we've got non-farm payroll data Friday and quite a big week next week with US CPI and other things like that. More on that later. But we've got a pretty clear situation that the Fed is quite happy to see higher unemployment levels. They do feel that the tightness in that market at the moment, as you can see here, this soft labour demand is beginning to shift a little bit. But to be honest, looking at non-farm payroll data coming up this weekend, again, more volatility likely in the markets on the back of this. I wouldn't be surprised if unemployment is beginning to shift a little bit higher. But again, it doesn't mean the Fed is going to stop hiking. And they're making this extremely clear. They want to see the demand side pressured, and they're going to keep that pressure on until they get inflation back to 2%, which is a long way off from where they are right now. We need to remember that. Is 2.5% interest rates enough to get inflation down from 9% to 2%? Probably not. So we have to bear that in mind and what the implications of that really are. So, Friday's going to be another volatile day. Economic data now potentially right up there with everything else as a potential volatility instigator. If they're data dependent, we have to be as well. And that's the message I'm trying to get across here. So traders need to be central bank focused, but we need to be focused on the things that they are telling us about. They're making this very clear. They're not done yet. They've got more to do. And for where they're sitting, they have not had the impact so far that they wanted to see. And I think that's really important going forward. So stock index volatility, central banks are still very serious about fighting inflation. They have made this abundantly clear. And if we look at what's happening around, not only from the Fed, we've seen a 100 basis point hike from the Bank of Canada at one meeting. We've seen 75 from the Fed, and we're now beginning to see another 75 basis points priced in for September. We've got a surprise 50 basis point hike from the SNB and the ECB recently. And yesterday, the RBA raised 50 basis points for the third straight month. But again, the RBA abandoned forward guidance, and the market took that as a negative. And I'm surprised. I don't know why they should do that. It does not mean that the RBA are going to stop hiking. So tomorrow, the Bank of England is set for its biggest interest rate rise in 27 years. It looks like we're going to get 50 basis points. It's seen as relatively aggressive, but with inflation where it is and what's going on with the tightness in the labour market, I wouldn't be surprised if we saw 50 at least. I do think, however, if we see 25 basis points, then sterling would get pretty hard and push down hard. And I think that would actually exacerbate the inflationary problems facing the Bank of England. And I don't think they want that. So I think 50 basis points is a sound ballpark area for them to go. I do think sterling has a role to play in all of that. But it's beginning to be priced. There's about 42 basis points price. So market going more for a hike of 50 basis points. I mean, it did waver down to about 37 basis points not long ago. But, I think this is what they need to do. And I haven't heard anything from them to suggest otherwise. I just think 25 basis points with inflation where it is would be too little. And stock volatility ahead. I mean, if we look at the S&P, it looked like we were going to roll over yesterday and this morning. We've seen a decent rally back up into the close. Well, before, not even at the close yet, but today rallied back up. Strong data out of the US has helped that to some degree. Some people suggesting earnings might be able to survive a little better with that. But again, more volatility. We haven't quite broken those 29th of May resistance highs around 42.01. More on that possibly from Richard later, but I think realistically the whole thing here is that the market is beginning to focus back on what the central banks are telling us, and that's quite right in my view. So this stock market may find it a little bit difficult to push up above these previous highs that we've got on the chart on the right here. So expect more volatility ahead. It's not going to be easy. I think the low-lying hanging fruit has been picked on the bounce. It'd be interesting to see if the market wants to start selling into these rallies again. Is it a bear market rally? Or have we got a base in place? Listening to what the central bankers are saying, we may be testing back down again at some point. But at the moment, stocks look pretty vibrant. Earnings have come in better than expected on some basis. But I think the danger here is that volatility seems to be set pretty high, and that could be ringing some alarm bells around the marketplace going forwards.